in the interest of the panelists who are going to come on stage, who might have this request and on their behalf, we will request all of you to step up and engage the front rows of seats, the ones that are empty right now, so that they get a fuller audience feeling. And it also gives opportunity for others to join in as and when they come in. Please, I know it's a little difficult when you have settled in, you have kept your bags, but yes, let's move a little bit and occupy the empty rows of seats in the front. I'll just give 30 seconds for all of you to do that, and I'm going to invite our panelists on stage. You saw on that video that our Honorable Minister was also here. He spoke to us in detail yesterday about Kerala's investment potential and how entrepreneurship is the way forward and how technology is enabling that whole journey. It was really a proud moment for all of us to see our Minister talk about or highlight Kerala's stellar journey so far and the future journey as well. Not much movement? Not interested? Okay, let's arrive at a deal. Be at your seats where you are comfortable, but do engage with the panelists, the speakers, as though you are in the front rows. Alright? Deal? The moderator, my dear friend Mr. Rajesh Nair, is going to have a good time engaging them, and without any further ado, for this first panel discussion on how angel networks select and nurture startups, I'm going to call on stage first our moderator, Mr. Rajesh Nair, who is an investor with Kerala Angel Network. He is also a partner with Ernst & Young. He's also a member of the governing board of Kerala Startup Mission, a cheerleader, a member of Kerala Startup Mission in every way. Welcome, sir. As the first panelist is the president of Kerala Angel Network, and is also the co-founder and CFO of Next Education India Private Limited, Mr. Raveendranath Kamath. Our next panelist is the managing partner of I Varghese and Associates, which is a leading chartered accountancy firm, and he is an active investor with Kerala Angel Network. On stage next, Mr. I Varghese. Chairman of MN Holdings, past president of Thai Kerala, and the founder president of Kerala Angel Network, Mr. Ajit Moopan. Over to you, Mr. Rajesh Nair.
Thank you, Adra. So we have this League of Extraordinary Gentlemen out here. All of us have been part of the initial journey of CAN, now of course under Kamath's leadership. It's going the next strides of growth. So what we will try to cover during this panel discussion today is about a little bit of brief on what we are doing in terms of investments, what are the kind of investors we have, what's the broad investment thesis that we have. How do we nurture our investees, and what is it that we do on a regular basis? So, since we are not doing detailed introductions, let me just, very broadly say a phrase about them. Kamath is the nerd amongst us, and he has a really wicked sense of humor as well. So, he's the current president of Kerala Angel Network. Ajit is a perfectionist, he's a perfect charmer, and he's the methodist who drives a lot of people wild, including the secretariats. So we have Ajit here, and I think CAN, the way we see today, is largely the work that Ajit did in the past. And Roy sir is the vice consigliere, who we go to all, for all questions and answers. Roy sir is whom we approach. Having Having said that, I'll start with Kamath. So Kamath, if you could broadly brief about what are the kind of investments we do, what are the sort of investors we have, and your experience in terms of how do we nurture some of our investee companies.
Morning, everyone. First of all, I would like to thank, or rather, I don't know, congratulate or thank the KSU for such a fantastic event. So I couldn't, coming yesterday, I was walking through the exhibition halls. I think 50% of the companies we have not known, so which is really a surprise and pleasant surprise, right? So there is a lot of innovation happening. I think that's really fantastic, right? So talking about CAN, if I may take a minute, could you please put up the PPT? I have one slide that talks about it. So this sort of sums up what we have done so far and what we are trying to do. So we are established about 4 years back. We are part of the global organization called TIE, the Indian Entrepreneurs. We are part of TIE Kerala, which is essentially a non-profit. So as when I say non-profit and we say we are investment network, you might ask, are we charity? Absolutely not. So the entity, the organization does not make profits. That's what I mean. But the individual investments are purely for profit. So we are very clear what it is. And there is this whole notion of what is angelic about it, right? So since he's talking about a wicked sense of humor, but that is true. See, a typical angel network looks at returns or IRR of about 25-30%, which is, probably you will say it's almost like credit card debt. So what is angelic about it? Why is it not called hawkish? Is probably that we invest in equity and we are completely aware of the risk we take and we are happy to write it off if the business goes down, right? We take that risk. And that is why the risk is high and the returns have to be high. So in the last 4 years, we have made about 14 deals, about cumulative investment of maybe about $15 million, including the co-investments that we have done. We have done about 9 co-investments, second round, third round investments. We have seen failures also, but we have a fantastic network of members, mostly comprising of HNIs and family officers, and we want to build together, we want to invest and grow together.
Thanks, Rahul. So I'll go to Ajit, and Ajit, if you could probably begin with some of those initial difficulties that you faced when the formation, to get it started itself. We've all been hearing about Angel Network for a while, but how did you get it started? What was the initial impetus, and what are we doing? Again, with maybe an example of one of your investments and specifics on how are we supporting them and the value add that we bring to some of our investees.
Yeah. First of all, thank you for the generous introduction. I don't know if I deserve. I'd be happy to speak about the formation of Kerala Angel Network was not on Kerala Pyramid in 2019 November. But effectively, we are only 4 years old, starting in 2020. Our first investment was in 2020. I must also acknowledge the role played by Chandu Nair, who educated us in angel investment from Chennai Angels, held many workshops for us. So the mindset, most of us in Massachusetts, as Kamath mentioned, this is promoted by TIE Kerala. We have TIE members as well as non-TIE members in this network. So initially it was all time members. So most of us at time, it's a very diverse set of domains and time chart membership. So many of them are groomed in the conventional business of ROI, kind of conventional businesses. The large size, of course. We have our share of techies also in the membership. So converting from an ROI model to wealth creation model, the mindset, that was one of the bigger challenges initially. We started small with I think 20-25 members, and now we scaled to 70. I was also acknowledged the whole seed of the idea came from Rajesh forming the network some time before, and even put the domain name and all that was done by Rajesh. I took it from there, and during my presidency of time, Kerala in 2020-22, with the ample support from all three colleagues here, also the management committee members. So it's a collective effort launching it. Now, to go into some lessons on the nurturing part, I could take a case study of one of our portfolio companies. It's a ready-to-cook D2C brand. So it's called Cooked. When we invested, they were, say, 10 lakhs in monthly revenue. And now, this month, they will touch 2 CR. Okay, this is 21 investment, and there were 4 follow-on rounds. And the recently concluded round, which we also participated, the valuation has grown 5x. So I'm setting the context here about the growth, scale up, and also, let me also put in a word to add to the perspective. Typically angel network comes in after the seed round, before series round from whether a fund comes in formally, typically. There are exceptions for this. So fund round, the seed rounds from friends and family, and in between the angel network comes in, right? And our thesis itself is that we get it when there is some revenue boosted and some revenue traction. So in this, since they were in the ready-to-cook space, I had to prompt a lot of, there were 2 members in the network who could support this. So one was already a member, which is Cancor, Man Cancor, Jimon Gora, CEO, who had said, he was already a member. Then I roped in Aju of Sintai, whom I had a personal connect with. He was also a Time member, so it was easy to persuade him. So they both came in, and they gave immense support in terms of product R&D, product development, and even production, manufacturing, because they work on an outsourced model. And this, so with their support, I think that was instrumental in taking the growth up to, say 80-90 lakhs. But I should also add, Adityan, the CEO, founder, he's a very resourceful chap, very smart entrepreneur, and it is a combination of his skills also. And so then with that support, he started outsourcing from other companies as well. Besides that, we also help in connecting to other funding of potential partners, go-to-market, marketing channels. So now we work on omni-channel. We started with only D2C. D2C was not very profitable, as you know. Then now the quick commerce channels came in, and they are in most of them. And they have also expanded to retail, offline retail. So with all these, they have done the scale up to this level, and they are expecting to raise the Series A in February or March, and proposed valuation comes through, it will be a 10x growth for us investors. So this is the kind of nurturing that we do. This is an example. Thank you.
Thanks, Ajit. Roy sir, if you could touch upon, what are some of those regulatory tips or takeaways you have for them in terms of structure? How do we look at them as entities? What are some preferred models? And maybe a little bit of what valuation is.
Thank you, Rajesh. You always like to throw the tricky question. Jokes apart. Evaluation is something I think if you are at the pre-revenue stage and all, don't get worried about valuation at all. Well, I will just cite one of my chats with a person called, you call him Nat. He was the fund manager of Ratan Tata's family office. So I asked Nat, how do you look at valuations? He told me, Roy, there is nothing like valuation. I look at the value of the business only. Second is, he said, I try to see whether the founder is for a long-term play. Having said that, valuations are important when you approach for external funding. Most of these startups, Ajit has already mentioned, are funded by 2 Fs. Actually, there are 3 Fs. Friends, family, and I don't want to mention the 3rd F. So, you pull along as long as you can bootstrap yourself. We have come across many companies which has even funded up to 1 crore for product developments through a lot of government grants from DST and such situations. And they are just now only after the commercialization looking at valuations. Until then, my submission is don't look very much worried about valuations. Of course, when you are in revenue stage, you need to look at valuations because at that stage, you are going to concede a portion of your ownership. You have to be very judicious. I would suggest that companies or founders in that stage primarily try to attend some master classes on valuation. Because a lot of your myths about valuations will be busted. Because in reality, as Shakespeare has said, the beauty is in the eyes of the beholder. You may think that you are beautiful, but the beholder decides what is beauty. Okay, Kamath wants to add to that later. So traditionally, I am a trained accountant. So traditionally, valuations have been in the 90s. You have so much assets, you have so much liabilities. The net is the value of the entity. Plus, if you are fancy enough, I want to buy this business, you add a goodwill. But that was for all linear businesses. Because in the till 90s, every business was linear. After that, technology disruptions happened and the businesses start growing exponentially. If you are still a linear business, I would recommend in the initial stages that as a easy finance, that as a safe finance, because you don't concede your ownership when you are on debt. But if you are on an exponential business, you need a lot of money on social media, channels, a lot of advertisement, then you require valuations. Traditionally, the valuations have been moving from asset liability model to cash flow models. What is the future cash flow this organization will generate? Always cash is king. Or the potential of the organization to generate cash. There are different methods, and nowadays we use a multiple of different methods, potential, discounted cash flow to arrive at the valuations. I think better some of you are in those stages, attend 1 or 2 master classes to understand in detail, because it's a whole 3-4 hours subject. Second, the entity. An outside investor always comes in at the right time, and he would like to exit maybe after 5 years, 6 years. So your entity should be such that the investor can come in and do exits. So proprietorships, partnerships, LLPs only, and I have come across many LLPs which startups start. Later on we advise them to move to a private limited company. Here is one word of caution. Private limited company formation may take 2 weeks, 3 weeks, but closure may take 2 to 3 years. Because you need all sorts of clearances from tax department and so many things, and you have to keep it dormant. So do a little bit of homework in what stage your business is and go for a private limited company, because people like us who come and invest would like to be shareholders of a private limited company so that we can exit. If you are in a partnership, it's very difficult to exit. I think I will leave the rest of things.
Thanks, Rohit. Just to share one experience in terms of one of our investments where I'm lead investor. It's a company called Zappy Hire. So what do we do, and so how do we review, etc. So we have these fortnightly calls, and of course emails can happen at any point of time. What we focus on is on some experience sharing in terms of how we run our organizations and how, what are some ideas they could pick up. The other is on access to markets, which means if we know somebody who could potentially use their product, we normally help them and get them connected. Access to finance, because it's not just angel round, but there are lots of small milestones during the finance journey as well where they require help. And of course, the secondary, what happens next? What if there is a potential acquisition opportunity, etc. All those things is what we discuss. But in general, the spirit is to help them as and when they require. So I really believe in the pull model rather than pushing them to do a few things. And that's the broad model that we follow. I'll come back to Ajit. Ajit, in terms of again the same valuation question, if you have something to add for the audience, and then exits. So what do we tell some of these startups who come to us on what is our vision for exits, and is there any sectoral focus, or are we biased towards any particular sector in Canada?
Of course, I'll take the last point first. We are sector agnostic, as we always said. Even if we have invested in one sector, we don't mind to add another company or the merit of the founders and the business model and all that. So we never, we always remain sector agnostic. Yeah, on the valuation, I just like to compliment what Roy mentioned and also add another perspective. First, I just emphasize what Roy said initially. The valuation comes into play principally when you approach a fund, external fund, the fund, the VC professional fund. That's when you get Series A. That's when your real the focus line should be on the valuation. And then the most important point, the founder's stake should be significant. Like ideally 55%. Correct me if I'm wrong. So within that, you have a lot of leeway. From your seed round, if you do pre-series, one round and then a bridge round and then reach Series A, maybe 2 or 3 rounds sometimes. Sometimes some startups are fortunate to just have just 1 round of angel and funding. So I look at it very simplistically, because the many a time, there are some good deals which have come to us which falls through. It doesn't fructify for the simple reason of very high valuation. Of course, we all founders have we have this unkunde syndrome, right? So somewhere along the way, the valuation tend to get also connected to the pride or self-esteem of the founder. These are all, inadvertent things which happen. But I'm just touching upon, there are sensitive things. We're just touching upon it because, in the journey of a startup is to, like in the range of days of exponential growth, the quick acceleration, growth, funding, and, journey which continues beyond, exit or acquisition, or to a serial entrepreneurship. That must be the play here. In that perspective, I'm sharing this. So, I'm taking an example. We say in a friends and family seed round, you have say divested 10%. You raise 1 CR, divested 10%. The founder is left with 90% stake. Okay, set aside 10%, 5 to 10% for all the ESOP and all that. You have still 80%, right? So, then you have to raise in between pre-series, you have to go for funding. Say the figure is 2 CR, and that is going to last you 18 months, the runway, right? And then it is simple, how much more you need to divest. Okay, you are left with 80, you can easily divest 10. Okay, if you divest 10, it's 20 CR valuation, right? Pre-money. So you keep a buffer. After this round, then you are from 80, you are coming down to 70. You keep a buffer of another 10% for you. Then even if you raise another, divest another 10 more percentage, still you are at 60%, right? So this could be, Royce is here, who's a professional CA, very number-wise, the revenue-based models and profit-based models of valuation. But I'm looking at a very simplistic stake and runway. So I'll stop with that.
So Roy sir, again on the funding model, something bad on the valuation part which Ajit said. And again, from a I come back to that regulatory standpoint in terms of most of them spend time on their idea. They would have not spent time on documenting their company per se. So what are some of those things they should really look at?
Thank you, Ajit. What I wanted to speak, Ajit has already said on the sliding scale of funding. I only want to add one thing there. We look at a runway of 18 to 24 months, and the owner to dilute anywhere between 8 to 15%, only during that round. A maximum 15%, because we need, as an investor, I need to see that bigger investors are coming and there should be space for them to enter. But ultimately, the promoter should not become non-promoter below 50. So ideally, we look at 18 to 24 months runway, so that the next round comes somewhere around between 21 to, because any round on a larger scale takes 3 to 6 months for negotiations. In our case, being angels, maybe we issue a term sheet if we are okay, with probably with a 30 days to 45 days time period, and we try to close the deal. But when you go to the next round, your lead time may be higher. That's one. Second point is, once we issue a term sheet, if the deal is very small, we may not go for a very big due diligence. But if the deal is big size, for us a deal of say 5 crore, 6 crore is a big deal from an angel's point of view. So we will go for a proper financial and legal due diligence. So the startup should be able to get its activities, we call it sanitized properly. Maybe you have a lot of regulatory things to comply with. Once I was discussing on these regulatory things with Kamath, he was telling me there is a batteries law in India which requires to be complied, which nobody was knowing probably. And due diligence, I think it was done by Anderson and They said there's a battery law. Have you complied with that? I mean, there are so many small things like this. Probably at this stage, you need to be more compliant. What happens with the startup in the initial stage is they are in a rush. We can understand that they want to move very fast with their product, services, everything. And they may not get proper advice on the compliance part. Probably, once you are on your 2 feet, please go to good mentors. They will connect you to good financial advisors or people who are very well versed in the company law matters and things like that. Please take care of it. And the third point is, once you, after the term sheet and the due diligence, there is a process called shareholders agreement. This is where the angels or the VCs put in a lot of conditions. There are 2 kinds of conditions. One is called condition precedent, CP, which has to be complied before the money flows. There are certain conditions which are called condition subsequent, CS. We give them, okay, they may have a lot of compliances which are not very critical. We give them a lead period of 3 months, 6 months, you comply. So these are the broad things, and normally angels invest through an instrument called CCPS, which is actually a debt instrument which is converted into a share, but that debt has only 0.001% because it is actually an equity, but it is formed as a debt, and that's the common model. There are other models also, but as an angel network, most of the angels, almost I think 95% of the angels invest through CCPS. So we invest because there also what you have to see is CCPS is issued at a particular valuation. And sometimes on the second round, there may be a base valuation and there may be a cap also. Which I think we can discuss offline if you want, because the time constraints. Thank you, I'm done.
Kamath, 2 quick questions. One is, what do we look for in our investments? And I think to summarize, what is the vision for your vision for CAN?
I'll take a minute to crack a bit of a joke. So we were beating valuations to death anyways. So now all of us know that the whole angel tax is gone, right? So angel tax in itself is, I don't know why it's called angel tax, but it's demonic, right? It's gone. So people used to come to us with a valuation certificate from a chartered accountant based on some DCF and whatever. And we'll say, look, this is the valuation we have. But again, it's up to the investor and the investing company to decide. So that is more like, I used to, tell the investors, the situation is like this. Between the investor and the investing company, we have decided on the valuation. Now, the law is such that you need to have a proof of that valuation. So it's akin to, a boy and a girl liking each other, but the families are insisting on astrology and Jadam, Jetam. So you go to the astrologer and get Tirumani Indranam Parihara, right? So, a lot of it is, reality is like that. Valuation, don't harp a lot on these numbers and comparisons and, I have this, you have this. I think the core point which we actually help the startup also, again, with the quote of those who are willing to listen, is to conserve what is the actual cash to get. Don't go for some fancy numbers, fancy investments and all that, right? And I think that is where as a network we can help, right? We have, and not only us, not as a network, all the angel networks will help you through that in the initial phase. There will be a varied set of people that will be part of the network. And I don't know if you're aware, so there is a SEBI mandate on who can be an angel investor. It's a high risk class. So City has put in some qualified investor criteria. I think it's about 2 crores of AUM, excluding your primary residence and all that. So similar standards exist in the US also. It's primarily to protect investor and the investee, right? Again, startups is a high-risk business. Probably 80-90% of the companies will perish, and hence it is important to take the right investment. Right? If you are taking debt, again, just be sure of what kind of terms are attached, right? So you have to weigh that in. So again, just to add to that, for those of you who are HNIs who want to participate, see, you can't build an ecosystem or bring about change in standalone. Even the governments can't do it, right? Only startups can do it alone, right? So it has to be the ecosystem that has to work, and if you have the ambition and the guts to get into it, and of course, if you meet the criteria, then I would suggest you reach out to one of those angel networks or become an LP in a fund if you have that kind of AUM. Yesterday there was a panel, I think, about most of the prominent networks here. You can connect to KSUM, you can connect to whoever you like, right? And most importantly, in the region. Coming back to your question, vision on the vision part, right? I think we need fundamental change, right? So if we have to improve, if we have to keep growing, I think it is only possible through a lot of innovation, a lot of growth in terms of not just monetary, in terms of infrastructure, in terms of all aspects of life. Right? Where we want to play, again, part of, especially as a part of TIE, is, okay, TIE has this, I would say, very ambitious goal saying, every home should have an entrepreneur, right? It will probably happen one day, or all of us treat ourselves as entrepreneurs, not as employment seekers. We would probably like to reach one investment a month, probably in the short term, so next 2 years. So in the 4 years we have done 14, I think we want to reach one investment a month. We have, I think we are poised to do that.
Yes. I want to add one point. Evaluations. Please don't compare your entity's valuation with some well-known valuations in the Silicon Valley. Because if somebody comes to and with a pitch and say that look, mine is similar business and this is the valuation, we start having the first red flag there. Because your business you may be comparing, but your business may have, unless you have uniqueness, and it's not easy to compare with Silicon Valley valuations. So we see the first red flag there. Please.
So, before I sum up, I just want to give it to Kamath once more. Kamath had an interesting announcement regarding one of our new investments. So, a quick minute, Kamath.
I think this week we have seen 2 term sheets getting signed. One is those of you have known, he's the whole full-time investment manager for CAN. He's signed a term sheet for 50% of his equity, right? So on the personal side, so he can be there. But more importantly, we are very happy to announce 2.2 crore investment into autonomous vehicle startup called Roche.ai, which is signed the term sheet, and this is probably the second largest deal that we've done. And I think
Roche.ai.
I think it can make a fantastic difference.
Let me also add, it was subscribed in 24 hours, that deal. So let's give a hand to Kamath.
Just to sum it up, one of those questions when we do these conferences, one of the questions we always get is, Again, coming back to, you would have heard the answers from all of them. What do you look for in a startup? So, what are those 5 things that everybody wants rules, everybody wants bullet points. So here are some 5 things that I have seen really help us. One is we look for technical excellence in the product or service which is being pitched. The other is their ability to understand the strategic focus of the sector, where they are playing, etc. That's the second thing. The third thing is the team needs to be an outstanding team on paper and otherwise. The fourth one is reasonable finances. Reasonable understanding of finances is necessary. And the last one is they need to have a sense of urgency. A sense of urgency in terms of what they are doing, how they are planning, etc. So having said that, we'll open it up for questions. If you could mention who you want the questions to be answered. Are there a couple of minutes? Yeah, so we have around 3.5 minutes. So you could take 2-3 questions. Questions, please, just a reminder, questions, no comments, just questions. Yeah, please.
So yesterday we had our Honorable Chairman of ISRO talk about 2 things. One is developing applications and the other thing is about components. Okay, if that comes, then what he said was the government of India has earmarked 50,000 crores. Okay, now if you have to start up, even before asking for the 50,000 crores, the base thing, like how WhatsApp did, those 2 guys got together and did something, and then the other friends gave 2.5 lakhs of US dollars. So can we have, KAL, chip in the base, we will give you the financials. And this is for Raveendranath Kamath, sir.
That is what we do, right? But it's not as simple as 2 friends meeting. It will probably be a process. So we have a filtration process which maybe about 100 deals get scrutinized till one gets invested. So it's a give and take, right? So you have to go through that process. If it passes, absolutely. That's what we do.
Hi, Ashwin.
My name is Rohan. Question I think would be for Mr. Kamath, but it's open to the floor. How, when the founder is building a product and they're focused on the product, the segment, the user and all that, and many times they forget about the narrative. And when a founder approaches an angel or an investor, how important is cracking that narrative in 30 seconds over the product?
I think stories sell, that's the reality. But I think narrative is important, but ultimately I think we hope that we can see through that narrative and see the merit. But ultimately the substance will win. And then it is also, it's also a gut call of the investors whether it will grow, right? So it's a mix of that.
Thank you.
I don't know if I answered the question.
Because I have an analogy normally goes back to media and entertainment with every human has a story, but not every human is a storyteller. So from that point of view,
Just to add to that, I think it's unfortunate, but while there is a grammar and there is arithmetic related to the idea, the storytelling is equally important. That's where you really communicate the power of the idea.
All right, thank you.
Last question.
So very quickly, just 2 things I wanted to know from the panel. You spoke about CCPS as an instrument and its acceptability. So from a startup point of view, is there any acceptability in the angel network circle for instruments such as CCDs or OCDs, which gives a lot of breather to the startups in the process of growth? A. And B, is there any expectation for a board seat at the initial level when an angel enters the company for investment?
I do agree there are different instruments, but what we have found is CCPS is the most easy one. Of course, if you go to 100x different note, which is an adaptation from the US. But under the Indian context, we still feel, because all of us are investors, and we still feel from a regulatory perspective and all CCPS is the best one. Your second question was, okay, in the term sheet and in the shareholders agreement, we do reserve certain things for us. We do reserve a board seat, but most of the time we don't exercise that, and we have never exercised that. We will most probably reserve an observer position in the board. Because we don't want to get into the management on a day-to-day basis. But certain things we reserve for us in the sense, if you want to sell the company, we are also part shareholders. We don't want you want us to discuss with us. I can't hear you. I would say it's a mix of things, because we want to know where the journey is, but we are not getting involved on a day-to-day basis. We are sort of viewing you with a telescope. Did I answer you?
Just to complement, you also mentioned CCD, right? Yeah, so like Royce said, 90% CCPS, subscribe shares. But when there's bridge rounds, like you've done one raise and you were expecting to, raise it in 18 months, but your runway get extended by 6 months, and you are the startup is forced to raise one more round, and therefore, but the business has grown from the last round. So, it's on a discount, this is a convertible round, completely convertible debenture. You raise it, and the next round gets converted to shares. The next raise, right? It's 25%, 30% depends on negotiated. So that is how it is done. It's very rarely used. Yeah, rest of the questions can be taken offline. Thank you.
Thank you, gentlemen, for keeping it on time. And there was a phenomenal panel from the etymology of the word angel to the intricacies of the process of investing. They covered comprehensively on the topic. Let's hear it loud for his colleagues from the Angel Network. And I request our moderator, Mr. Rajesh Nair, to present a memento to our three panelists, starting with Mr. I Varghese, Mr. Ajit Moopan, Mr. Raveendranath Kamath, and to present our token of appreciation to the moderator, can we please have on stage Ms. Surya Tanga, manager of Kerala Startup Mission. Special thanks for those bullet points, Rajesh sir.